You've heard it 1,000 times. Passive income. Work once, get paid forever. Money that shows up while you sleep, while you travel, while you finally do nothing. And every time you hear it, a small voice in the back of your head says the same thing. Why not me? So let me show you a number nobody in those videos ever puts on screen. The median net worth of households headed by someone under 35 is about $39,000. Now hold that number, because here's what it actually generates as passive income. A few $100s a year. Maybe 1,000 if you stretch. Not a month. A year. That's the part the dream skips over. Because passive income isn't a strategy problem. It's a capital problem most people never run the math on. And today we run it. Before we go further, quick context on why this channel exists. This is Max Sense, where we make sense of money, not by selling you a feeling, but by showing you the machinery underneath it. If you've ever watched a passive income video and felt that quiet mix of hope and inadequacy, this one's for you. Subscribe, because what I'm about to walk through is the exact conversation that industry is built to avoid. And not all of that is investable cash. Most of it is tied up in a car, a little home equity, checking accounts. Let's start with the rule everyone borrows and almost nobody understands. The 4% rule. Here's how the internet uses it. Build a pile, live off 4% of it forever, never work again. Clean, simple, wrong. Because the 4% rule was never a passive income strategy. It was a retirement spending rule. It answered one narrow question: how much a 65-year-old can pull each year and still have it last around 30 years. It assumes you've already done 40 years of accumulating. It was never built for someone trying to stop working at 28. But forget the misuse for a second. Let's just take that friendly 4% and point it at real wealth. $39,000, the typical pile, at 4%, that's about $1,500 you could withdraw in year one under a retirement rule. At a realistic dividend yield, closer to 900. At the yield of a plain total market fund, under 400. Look at those numbers and ask yourself an honest question. Which one pays your rent? Your health insurance? Your groceries? None of them. Not one. And here's the cruel part. People keep believing anyway, not because they're foolish, but because they're optimistic in a very specific way. Older Pew data found that among young adults who didn't earn enough, nearly 9 in 10 expected they would in the future. That pattern of financial optimism hasn't gone away. That optimism isn't a flaw. It's human, but it leaves a wide open door, and the passive income industry walks right through it. So that's the setup. Now let's break down the 4 reasons this fantasy keeps winning, starting with the one made of pure arithmetic. Picture someone. Call him Jordan. 28, makes about $42,000 a year, has clawed together $18,000 in a dividend fund. And he's running the dream in his head. What if this could replace my paycheck? You've done a version of this. Maybe on a calculator, maybe just in the shower. You imagine the balance big enough that the income covers your life, and you feel that flicker of freedom. So let's finish Jordan's math for him, because he never quite does. To replace a $42,000 income at that friendly 4%, you don't need a big portfolio, you need about $1 million. To replace it with actual dividends, where the yield is lower, you need closer to $2 million. And these aren't doomsday assumptions. They're plain arithmetic on top of mainstream, low-cost funds. For the typical worker in his early 30s, earning around $59,000, the number at 4% is roughly $1.5 million. Now put that next to what young households actually have. That $39,000 median. At 4%, the pile you'd need is about 27 times that. On dividends, more like 48 times. For a slightly older, slightly better paid worker, it climbs past 60 times. There's a name for what's happening here, and it isn't laziness. Smart people anchor on the wrong number. They fixate on the yield, which feels controllable, and ignore the principal, which doesn't. 4% sounds achievable. 48 times your net worth does not. So the mind stares at the number it likes, and the official data sharpens it. Among adults under 30, only about 1 in 5 says their retirement savings are even on track. Most don't have a tax-advantaged retirement account at all. So we're talking about people who haven't reached base camp, staring at a strategy meant for the summit. So when Jordan looks at $18,000 and imagines it setting him free, that's not financial independence taking shape. That's a Costco membership generating roughly the price of one nice dinner a year. Here's how it shows up in your real life. It's the Tuesday night you spend 2 hours comparing dividend ETFs, optimizing a portfolio that, at its size, can't change a single bill you pay. The effort is real, the math just isn't there yet. Because passive income isn't a strategy problem. It's a capital problem most people never run the math on. So if the numbers are this brutal, why does the dream survive? Why doesn't everyone just run the math, sigh, and move on? Because passive income was never really about the money. Watch what happens when someone says the magic phrase, "My money works for me." You've felt the pull of that sentence. It's not the cash flow that lands. It's the identity, the image of being a certain kind of person. The kind who's escaped, who's above the grind, who doesn't answer to a manager. Researchers who study this have a clean way of putting it. Some things we chase aren't purchases at all. They're signals. A visible marker that broadcasts status, freedom, competence to everyone watching. And it might be the purest status signal money can't buy yet. You wear the identity long before you own the assets. There's a whole body of work on identity, the idea that the labels we attach to ourselves shape the decisions we make. Investor, owner, free agent. Each one quietly feels superior to employee. Listen closely and it's almost always moralized. A clean line drawn between money that comes from labor and money that supposedly comes from being smarter. Then there's the second thread, and this one's the most honest of all. Autonomy. The research on why people start businesses is striking. More than half-cite reasons that have nothing to do with money. Many earn less than they would working for someone else and do it anyway because not having a master is worth a measurable amount. That craving is legitimate. The problem is passive income content sells you the autonomy without the cost. Entrepreneurship is hard, risky, exhausting. The fantasy strips all that out and leaves only the freedom. Same destination, none of the climb. And the third thread is simple exhaustion. Work, for a lot of people, isn't just underpaid. It's draining, low control, unstable. Economists point out that jobs differ not only in wages, but in how much they cost you in body and mind. So when work feels like that, a story about escaping it sounds good even if the math says it's impossible. The story was about relief. That's why naming the math doesn't kill the dream. Show someone the 48 times number, they'll nod, and go watch another video. Here's how it shows up in your life. You catch yourself envying a stranger's beach photo about quitting their job. And the envy isn't about their money at all. It's about the version of you that got to stop. Now here's where it gets expensive. Not emotionally, literally. While you're chasing the feeling, you're often making a quiet financial mistake. You optimize for income you can see instead of growth you can't. Let me show you the trap with real numbers. Say you've got $50,000, already far above the typical young household. Put it in a plain total market fund and the dividends come to about $500 a year. Now tilt it all into a high dividend fund. Like the crowd tells you, your income jumps to about $1,100. So the entire reward for restructuring around income at $50,000 is about $600 a year before taxes. That's the prize. And here's the part that took finance decades to nail down. A dividend is not free money. One of the most famous results in all of finance is almost a riddle. Whether a company pays you a dividend or simply grows in value makes no fundamental difference to your wealth. You can create your own dividend anytime by selling a sliver of what you own. The payout isn't extra. It's one way of packaging a return you already had. And packaging doesn't change the contents. The dividend obsession at low balances looks less like strategy and more like decoration. You're not getting richer. You're rearranging how the same return shows up on your screen so it feels more like income. But real estate, someone always says, real estate is real. Rent is tangible. That's actual passive income. Okay, let's run that number too. The median new home in America recently sold for around $422,000. And for an investment property, not your own home, a rental, lenders typically expect 15 to 25% down. On a median house, that's somewhere between $60,000 and $100,000 down. In cash. Before closing costs. Before a single repair. So for someone with $50,000, the low end is already out of reach, and the high end is double what they have. The tangible path is further away than the paper one. Here's how it shows up in your life. The hours you pour into screeners and calculators and spreadsheets, solving the wrong problem with total dedication. When you have a small amount of capital, the job is to turn it into a large amount. Optimizing the income of a tiny pile is like polishing a car that doesn't have an engine yet. So who actually makes passive income off passive income? Let's follow the money. The answer's going to sting a little. Picture the creator. Clean kitchen, laptop, confident voice explaining how your money can work for you. Here's the quiet irony. His income isn't passive at all. It's about as active as income gets. He earns from ads on the video, from affiliate links below it, from the course he's about to mention, from the membership. The audience wants passive income from capital. The creator earns active income from your attention. And the platforms are engineered for this. In YouTube's shopping affiliate program, median commissions run around 15%. Every viewer is a sales prospect. Even regulators have flagged it. The SEC's own investor advisory group warned that financial influencers often earn serious money from ads, sponsorships, and fees. Researchers modeling the whole influencer economy described the same logic. The system rewards creators for selling emotionally resonant aspiration at scale. It does not reward them for telling you a $10,000 portfolio cannot solve a $3,000 a month problem. So he's not selling you a strategy. He's selling you a feeling. And the feeling converts really well. But here's the twist that makes this more than cynicism. The science says selling you the big dream might actively make you worse off. Researchers ran a program designed to raise financial aspirations. Think bigger, dream richer, the language at the center of passive income content. And they found a frustration effect. Crank up aspirations while the gap to reality stays enormous, and you can actually reduce how much people invest. The dream demotivates. Now compare that to what does work. A different set of studies found something almost boring by contrast. What reliably moved the needle wasn't inspiration. It was a specific reminder tied to a real expense, and it boosted savings by around 16%. Vague motivation, the you can do it, dream big energy did essentially nothing. Sit with that contrast because it's the whole video in 2 sentences. The grounded, specific, slightly unsexy approach builds wealth. The inspirational, identity-soaked, dream big approach, the one with the best thumbnails, can quietly leave you poorer. Here's how it shows up in your life. You finish a video feeling motivated, energized, like something shifted, and a week later nothing has, except the algorithm now knows exactly which feeling to sell you next. Now let me be fair, because if I'm not, you'll catch it, and you should. None of this means passive income is fake. It isn't. Real estate, over long stretches of history, has produced returns competitive with the stock market. A net rental yield of a few percent, plus appreciation on top. People genuinely do live off portfolios and properties. The concept is sound. The problem was never the concept. The problem is the sequence. For someone with $2 million, dividends and rents are legitimate. For someone with $39,000, the same strategy is a costume. So the honest version isn't that it's a scam. It's that passive income is the second move, and almost everyone tries to make it first. Accumulate, then convert. Grow the engine, then worry about the cruise control. Do it in that order and the dream is real. Alright, you know what's happening. Now let's talk about what you can actually do with that. First, run your real number. Not the yield. The principal. Under a 4% withdrawal rule, that's roughly 25 times your annual spending. Look at that number honestly. It's not meant to crush you. It's meant to tell you which game you're playing. Almost certainly accumulation. Second, separate the two jobs. Below a few $100,000, your job is not to generate income. It's to grow capital. That means broad, low-cost, boring accumulation, not chasing yield for a few $100s a year. Income is a richer person's problem. Third, replace the dream with a reminder. A specific goal tied to a real expense moves money. Vague aspiration tends to fizzle or worse. So don't set a goal to achieve financial freedom. Set a goal to invest a specific amount toward a specific thing by a specific date. So let's bring it home. The capital math says the pile you'd need is dozens of times what most young people have. The psychology says the dream survives anyway. The portfolio math says chasing income early just rearranges your returns. And the business model says the people teaching it earn actively from your hope. But here's what I don't want you to take from this. Not despair. Not I'll never get there. What stood between you and that future was never ambition or discipline. It was a number, one nobody put on the screen for you. The number doesn't sell. But now you've seen it. And seeing it is what changes things. Not because it's inspiring, but because it's true. Passive income isn't a strategy problem. It's a capital problem most people never run the math on. So go run yours. If this reframes something, tell me one number in the comments, the pile you'd actually need to walk away. And if you want the strategy for building that pile instead of cosplaying the end of it, watch the one I'll point you to next. Make sense of money. I'll see you there.